All right. So first, let's talk about ARM on April 17th, 2024.
Yeah,
Okay. Can you walk us through why that's such an easy layup trade for you?
sure. So the reason why I liked this trade was essentially the semis, NVIDIA, SMCI, ARM had capitulated probably about a month later. They got super euphoric, huge blow off candles. And so ARM then started to set up with support at $120. And then we had just consecutive lower highs against that support. And a lot of the concepts that I talk about are pretty similar. So some people have seen me tweet or do videos on the bouncy ball trade. And while not quite the same, the concept's there in that this formed support. Then we're having weaker and weaker bounces. The trade is still technically the backside, meaning we put in that euphoric top. And what happened was even the prior day, NVIDIA and SMCI were really, really strong. ARM couldn't bounce anywhere, and I think it was like nearly flat on the day. And I was thinking, wow, if these show any weakness, and if this breaks 120, it's just going to crack, and the floor is going to fall out. And there's so many different ways to trade this. You can trade this intraday, you can trade this as a swing trade, which is I know something you're always interested in expanding into. And that $120 break, it ended up trading just totally beautiful. And this is something that can be premeditated. It's not a super fast breaking news trade. It's not a super crazy GME, AMC, worry about halts and uncapped risk and stuff. And it's a very defined trade that you can plan for. You can figure out how much you're willing to risk. And that allows you to really hone in and attack these much better than some of the faster ones. And especially for me, when I was starting out, I struggled with the speed of the game. So what really helped me find my footing was saying like, okay, these are the couple categories of trades that are too fast. Like some of the scalps is just too much for me. What are the slowest replicable trades I can find? And those slow trades, even though they're not sexy, some of these are just boring whatever things, but they're just highly replicable trades. And so even this is essentially just a daily chart pattern. Anyone can scan for this. There's nothing that crazy, but you've got a lot of eyes. It's a super overvalued stock. It's capitulated. The technicals align. And once that breaks, it was just look out below.
So you had, I mean, when we talk about easy trades, I think it's really important to flesh out that it's a matter of, it's not just conviction. It's also the risk versus reward. You were never risking a ton of money in this trade. You have this stock, which is essentially trading on air a little bit, both for a variety of reasons, valuation, for structural reasons, for the move that it just had, for its relative weakness relative to the rest of the industry. And you have this kind of perfect level set up that once it breaks, there's really no support underneath it. So you could risk sort of, I don't know what your actual ad is, but a small amount, maybe a point or so, whatever it might be. I don't know, you could tell us. But in order to make this huge gap, if the bottom falls out of it, and because you've seen this happen so many times, and because you track the data and have watched things like this happen over and over and over again over your experience, you know that the likelihood is actually pretty high.
Yeah.
So the combination of those things is what makes it sort of an easy no-brainer trade to you. Instead of trying to figure out how to push your size in, that risky new thing, let me figure out how I can get 10x, 20, 50x in this trade.
Yep. And so many people will try to leave their lane rather than just say, hey, this is my strength. This is what I'm doing well at. I just need to add size. As long as your expected value isn't being impaired, if you've got good edge, you really want to push that gradually and prudently, but push it to its maximum. And so many people try and just always chase the shiny object rather than doing exactly that. And even with this ARM example, I think a lot of people, when we talk about data, like the reality is I didn't do that much intense backtesting. More important than any backtesting and the data was simply having a framework for how price action works and knowing these chart patterns. And like I said before, every chart rhymes, but none of them are exactly the same. And that's one of the flaws of backtesting. How do you really backtest something like ARM that doesn't have even much price data? How do you backtest something where we've never had semiconductors probably make that kind of move since I'd imagine, I don't know, .com or something? And there's not really that many comparables. How do you backtest something that has that certain amount of float locked up and all the other nuances? It's super hard. And instead, it's way easier for me to just say, look, I know broadly the data on this, but much more important is conceptually, this is doing as a chart everything I really want it to do.
Sure. So let's talk about a trade that you already brought up, which was GL on April 11th. This was a Funny Panda short, but the irony of this is that if you look at the chart of this, and we're going to put it up on the screen, it's funny that, it's kind of obvious that the trade is to short it, but your easy trade was actually buying it at the bottom. I should add.
That's the best place to buy.
And I should say that.
Did we tell you, John?
And for those who think that this is, I don't know, this is some sort, I don't know, but I can attest that this is truly something that Lance is immaculately gifted at, being able to read the bottom of these things. I'm a student of his. I'm still a student of his. And yeah, so just walk us through the variables.
The best way to buy at the bottom is to be the bottom and buy as much size to guarantee you're the bottom.
Well, that doesn't work out sometimes.
But when it does, you look like a legend.
Yeah. But I'm familiar. I'm very blessed to be familiar with the criteria that you're looking at in order to buy that bottom, and it is truly insightful. Can you walk us through some of the things that you were looking at that really caught your eye in that trade?
Sure. And so I would say there were two plays. Actually, probably the slightly easier trade was that breakdown after we had consolidated and were unable to bounce. Like I think that's actually to some
Shorting
degree shorting it is a little bit safer play, especially if you're a little bit newer. I think that short, once we couldn't bounce after that first leg in that consolidation, I think that's a pretty controlled way to get involved.
Mhm. So you're talking like right around like $90, or was that?
No,
maybe
it was
85?
later around like the 55 or whatever.
Oh, okay. I thought you were talking more around like
No,
the
once it had
$85
already
mark.
done the leg 80 and capitulated down to
Okay.
60, then consolidated.
Gotcha.
Yep. But I think what the really kind of the best trade in it was once that did then break down and capitulate. So that first breakdown, the short, is a little bit safer, definitely better for beginners. But at least for me and my playbook and my expertise, that move lower down towards $40, that was getting just so incredibly juicy to me. And again, why does my view different from the market and other participants? Because I had so much experience to back it up. And this is something I have cataloged and databased and traded so many times. And so many people don't have that information. They don't have that data. They don't have that experience. So when they see this, it almost becomes this reflective process of, oh, if we're down so much, it's got to be true. No way this is going to bounce or else we'd be bouncing. But what happens is you're able to recognize that, hey, wait a second, like now this is just pure capitulation, right? The stock started at $100. Some of these allegations are somewhat known. Not that I try to be an analyst, like I don't think you want to interpret the news too much, but nevertheless, we had a stock go from 100 to 40. There's a lot of coverage on this. There's a lot of analysts out there. There's a lot of people that have been following this. And it really comes down to recognizing the expected value and knowing from past experience just how far something like this could bounce. And I didn't hold this one that well. But when you go back through the data of all these reports, when something with these short reports really capitulates, some of those multi-day bounces can be very, very impressive.
I want to dig into that a little bit. I think people are saying, okay, everything you're saying makes sense, but how do I know where to buy it? How do I know it's at 40 and not 50 or 60? So what is it about this chart that screams capitulation to you at, $40 specifically?
So I did actually try to buy small size initially at around 60. But the bars weren't quite getting bigger. The volume wasn't quite getting so big. This was kind of the first really big leg. And so I think one of the most important concepts in mean reversion, which is so hard for people to internalize because it's scary, but the more legs something goes in one direction, the more probable a reversal becomes and the bigger reward and the less the risk, which is very rare, very, very rare, right? So let's say GL panicked all the way to $5. What's the risk? You're risking at not even $5. This company, even if it was bankrupt, is still probably trading at $1 or something, right? It doesn't go to zero. And that's in a worst case next day bankruptcy. So your risk is really only $3 or $4 and 1% of the time. But if these allegations are just total bullshit, or even if they're somewhat bullshit, then your reward when this stock's at $5 is so massive. And the probability of you getting some kind of bounce is near 100%. Now, obviously, we didn't go to $5, but I like to use those polar extremes to really suss out these concepts. So if at $5, you'd want hundreds of thousands of shares potentially, maybe at $10, you want less. But as it goes higher, there's certainly there should be at least some price where you're willing to buy because you recognize how good the risk reward is at that point. And so then we can do better than that. That's just one variable. Other stuff I'm looking at is I want to look at what is the volume like during this? What is the selling on the box? What is the aggression of people hitting the bid or offers really coming low? Then of course, one other thing that I talk about is then waiting for that turn. And the only downside is with some of these halts, you need to be careful that this was at $40. It was getting juicy enough that I was more scared that I wouldn't be able to get all the stock I wanted. I was getting more towards way aggression than defense. But especially if you're a smaller trader, you can wait for that turn. And by waiting for the turn, that then allows you to have a stop that still increases your probability. And so it isn't that I knew that was the bottom, right? Because in fact, I did buy small size in the 60s. And I think I broke even or lost minorly on that. And
so when you say you bought small size in the 60s, you're not fading this. You bought it and then you hit it. You got out of the stock.
Correct.
Okay.
Yep. And especially in general, I almost always have a stop, right? And so I did take one stab and it bounced in a way where like, even though I didn't make money, I didn't lose much either. And the more important thing is once that consolidates and breaks down and that goes another 20 points, so many people take their licks and their losses and they say, oh man, I'm not going to try this. Or maybe they even bought it off the open at $85 and they lost or something. And then they buy it at 60 and they say, oh, I've lost twice. Am I really going to lose a third time? And that is actually the exactly wrong thing to do, as long as you're still analyzing expected value properly. Because in my belief, in my estimation, expected value at 40 is probably 5x to 10x better than what it was at 60, and 20 to 40x better than what it was at like 85 or something. And your size and your aggression should reflect that. So, I mean, I don't know my exact position size at this point. It's just so many months later, but I would assume I probably got like 10x more size at the low 40s than I did at around the 60s. And again, because that's driven by the expected value, it's just so much better at that point. Again, the bounce is more probable. I still want to try and wait for that turn and get as much size as I can, which then allows me to have a stop. But it's recognizing that, wow, the meat on the bone, when this stock is coming from 100 and we're now at 40, the meat on the bone is enormous there.
So I think I want to point out for the audience that you're talking about a situation that is incredibly, you're talking the entire herd, all of Wall Street on enormous volume. This thing did 31 million shares that day, is going in one direction, and you're taking the opposite side of that. That takes an incredible amount of focus and objectivity. Trade that you sort of ascribe as the trade that saved your career. You were kind of out the door. You were, interviewing, and then this trade comes along, and this was your setup, and you went for it.
Yeah, and it's funny seeing. It's amazing, isn't it, that I was able to find all the execs in the chart. And when people talk about databasing and building these, I mean, this is that's 11 years ago now, and I was able to still find this in my notes and my records, and it just goes to show the level of work and the catalog. It's thousands and thousands and thousands of charts. And so this trade was special because on the daily, the daily chart, this was an exhaustion gap pattern. This was a pattern that I had studied quite a bit. It was something that we viewed as a higher probability pattern. We had our little system of where to short, where to add. And while the executions on the chart might look a little chaotic, and this is what also I laugh about with the Twitter world, is everyone's like, oh my God, show me the execs, but you can't really see the size related to them, which obviously convolutes some of it. But the most important part was I had this system and this expectation of where this stock will end up. And it was something I had seen before. It is something I had built those reps in. This was much like that ARM trade we previously discussed. This was something that I was able to premeditate. We knew the stock was gapping up pre-market, and then we knew exactly at what prices we wanted it. We knew what we wanted to see. We knew we wanted to see this huge influx of volume get sucked in off the open, then a hard fail. And what happened? It shot up to about 97.50. The volume was super, super massive. That added to our conviction. Then as it starts to roll over, add, then our target was this would kind of exhaust towards that Bollinger. And that's exactly what happened. And this trade, I think I made like 10,000 or 11,000 or so in it. But that was literally a career changing trade because that told me that I can do this. And I think my boss probably made 20x what I did, but I recognize that, wow, we did the same thing. If I can just build this skill set, that's life-changing money.
Sure. So I thought maybe quickly, I would run through just, as somebody who's learned from you, but who definitely trades differently. I'm a little bit more of a news trader. I would run through just one or two, just quick, easy trades of my own. So this QLYS from February 6th, this had gone down a lot on the day before on an analyst note that they had lost a Microsoft contract. And then in the middle of the day, they put out a press release that they were rescheduling their earnings. And the read through that I had was, why would you reschedule your earnings with your stock down that much unless you had a pretty good response? And I was able to simply buy this, thinking that the market's going to think this is a positive development. They're going to have positive things to say. I don't think that I took a lot of risk, and I was able to scale it up just because this is some of the stuff that we worked on.
And
MOR, this is a biotech stock that was actually acquired. This was an M&A thing. And for anybody who's never seen the way a buyout target or a company that's being acquired trades, it typically trades like a brick. It trades in a very, very narrow band because it's being acquired for a defined price. On this day, there was one of the most respected biotech reporters on the street, Adam Feuerstein. He writes for the Stat News, came out and said he didn't think the deal was going to close for a variety of reasons, that there was a problem with the drug and that it wouldn't ultimately get FDA approval, and they didn't think that the deal was going to close. And to me, it wasn't whether I agree with them or not. It's the point that there's this amazing analyst who's coming out and this is his opinion. That's new information. And given that the risk is so limited because they're being acquired for a price just north of where we are now, the expected value on this is really, really good. Because if he's right,
your risk is so defined.
It's so defined. If he's right, the deal falls apart. So I was able to get short this really quickly. And, putting that together, that, okay, this isn't just like a random tweet. This is, Adam Feuerstein putting out opinion on an M&A deal by an army of, meme people on Reddit, using money that they received from the government. It was more than 100% short. There were a whole bunch of structural reasons why they should be going up. So we have a situation where the stock should not be trading where it is. We know that, but the setup is terrible, right? Like you never know where this is going to end. Like it's probably the biggest short squeeze I've personally ever seen. And the thing that I took away from that was when you have a setup where there's the situation and the setup and those two things are in conflict, the setup has to win because it's not about knowing that a stock should go somewhere. It's about how you prosecute that idea. That's where all the money comes from. So Mara on January 16th, 2024, we'll throw up the chart. The chart sort of speaks for itself. It's a perfect example of that. Avgo on May 30th, 2023. Again,
Yeah, that was an epic move.
Yep. I think you did a video on this one specifically.
Yeah, I think it's possible. Yeah, this had the incredible daily chart and the intraday where they both aligned. And man, if you're shorting too early on that one, you're getting hosed because that is a hell of a move.
And then the last one was REV on August 22nd, 2022, which is just another really perfect example of the right side of the V sort of in action.
Yeah, and there's nothing so magic about this stuff, but I do think that like just based on human psychology and just liquidity and everything else, things do tend to trend at times. Then you have the weaker hands that make the tails of those trends, and you get the people that puke it both ways, to the downside or to the upside. And around those tails, if you can just wait and position yourself to be around for after that turn is in, it's just incredible expected value generally.
So another, classic Lanceism that you've brought in is you mentioned this a little bit when we talked about ARM was the concept of a bouncy ball. Can you walk us through this bouncy ball strategy of yours?
Yeah. So, and again, most of these concepts, a lot aren't necessarily so original, but a little twist. And so really the bouncy ball pattern, almost like we were discussing with the ARM daily chart, you have some type of catalyst that makes a stock do a leg lower or a leg higher. And you either form generally support in the case of the bouncy ball, and you have the support level, and then you do subsequent lower highs against that support, then it breaks. And so often that allows for a very, very defined significant level where when that breaks, it's such a good risk reward short. And so the nuances always matter. And so many people will be like, oh, is this a bouncy ball trade? And it's like, well, no, not really, because it might not make consecutive lower highs, or it might not be an in-play stock, or there might not be a good news catalyst, or there might not be a good daily chart. And so it's really finding all of these nuances together, and then the qualities of the setup. How good is the consolidation? How weak are those bounces into the break? Like AMC actually in GameStop, not this time around, but back in the middle of last month, those did on the big days where they blew out to like 11 and $80. Those were bouncy ball-esque, but they weren't quite sitting on lows. So like that setup, it rhymed and the concept was kind of there, but it wasn't perfect. And so a lot is just trying to interpret those nuances.
So, but when you come up with these, Lanceism names for these things, like right side of the V or bouncy ball, whatever else we're going to talk about, a lot of times you're just making a simplistic name for an actually very nuanced topic. So the concept of sort of the bouncy ball is really, you have this stock that, first of all, you mentioned it, which is kind of, I see this on Twitter all the time, which is people are asking if everything is a bouncy ball, but you really do have to have that fundamental catalyst of some sort in the beginning, because otherwise I can look, on any given day, I can bring up any chart and probably find like a bouncy ball somewhere in the midst of that chart.
And that's the concept of finding in-play stocks that are really moving with volume and emotion.
Sure. So you want something that had some catalyst to drive it somewhere, and then it sort of will consolidate or sort of pick a level at a certain point, but it's still trying to find itself, and it's either it's weak and getting weaker and then eventually cracks, or in the opposite, strong and getting stronger and then will crack to the upside. So that's this is an example, by the way, CDNA on January 26, 2024. I think this was your example, if I'm not mistaken, but this is, just another example. If you look like around 950, if you see sort of how it has that move down from 11 down to $10, trying to figure itself out, it's making, lower highs, and eventually it consolidates and just breaks that low and cracks.
Yeah. And so often, if I can interrupt, like people will be like, oh, but why didn't you take that first short at around 130, it went to lows and stuff, or what about closer to 2 o'clock? And that's where the nuances, like the quality and length of the consolidation really matter. And so
why does it matter?
So often traders will have the right idea, but because of these nuances that they're missing, they take too many stabs and just paper cut themselves. And that's also where that no man's land concept also comes from. But essentially, consolidation is a level of price acceptance. So around 1:30 and 2 p.m., I mean, I can't see the exact times from here, but you have, it's a little bit too rangy, where if you break to lows, there still might be people that are looking to take covers or people that are looking to buy. But when you really sit and consolidate on a level very, very tightly, once that level breaks and everybody knows it, there's nobody in the world really that wants to buy ARM at 119.90. or like remember some of the mega Tesla breakouts. What was the big level? I think it was what, like 900 or something pre-split. But it's like, if 900 is this big level that everybody's watching, you never want to be the chump that is selling at 901, 902, 903.
So I was actually thinking about something else. So you mentioned the fact that there's not going to be there anybody to buy after everybody breaks down, but I was actually thinking about the risk. So if you have a very rangy stock, well, then your out needs to really be at the top of that range, because an out, it's really important, isn't just some arbitrary
That's
amount.
both factors.
It has to be kind of a place where your expected value is you're wrong, where you're willing to throw in the towel and say this isn't right, like I'm wrong. So if you're going to short it in that kind of rangy part of the chart, then you have to be willing to give it to the top of that range. But if you have a very tight consolidation, then you only have to give it to the top of the consolidation. So your risk has gone down so much.
And you're touching on one of my favorite concepts, which I plan on doing much, much more on in the future. And that's really the geometry of these charts and understanding that, like, wait, if I'm using prior bars or the highs of this range, if this range is much rangier, if this bar is coming from all the way out here, then your risk is so much higher. And therefore your risk rewarded and expected value are so much lower. So those nuances of the proportions and the ratios of how these charts set up, it really, really matters to that expected value.
And
both factors really. It's both. So I would argue what we're touching on is, you're touching on that the rangier it is, the bigger the risk, which impairs the expected value. And I'm touching on that the worse the consolidation is, the worse the probability of a clean, successful move. So both of those factors are impairing the expected value. And when you align these factors properly, that's why you're getting all your things aligned, all of your things are helping you, and your expected value might go from negative to way better.
And we only touched on two things: the range of the consolidation and and the level being broken down. But there's also there's so much more. You also have there's something that you very famously talk about, the quote boringness unquote of the security. Like, is it something that's a really volatile security, or is it something that's not? Is it an M&A headline with a defined price, or is it some news catalyst?
What if 950 in that chart is a huge daily support level?
Right. What's the market doing? There's
What's the market doing?
I mean, there's what's the liquidity like? What's the volume like? There's just so many different nuances that you have to you can't just say, like, I'm looking for a bouncy ball pattern and draw it on a chart and say I figured it out now. There's all these different nuances that change the expected value.
Box at level 2.
Sure. And so it's really important to make sure that you're looking at your data to figure out what are the variables that would change this, then weighting them appropriately. Another trade that I don't think we've had an opportunity to speak about is something that, I don't know if you gave it this name or I just decided it's what it's called, but I called it the crack trade. It's just this idea of the gamma squeeze, where eventually something is just trading on thin air.
We trade equities, no crack. Come on, John. We're professionals.
And a chart will just collapse. And one example that I know you traded very well was SMCI on March 14th of 2024. Yeah. So this is just, I'll let you walk through it, but this is another Lancism.
Yeah. And so sometimes I kind of talk about, not that I don't think I've ever done a good video or well-defined some of this, but that will come. But the pendulum concept and the rubber band, essentially, where sometimes these things get so stretched in one direction, then you're dealing with gravity just really pulling it back down. Not that it can't go further, but once that trend does change, look out below. And so SMCI was riding the AI craze, and oh my God, it blew out earnings and guidance, and it starts exploding. And that feedback loop just starts to really, really send it. And through every measure, whether it's Bollinger Bands, distance to the moving average, the size of the bars, RSI, I think it had some like the highest RSI ever recorded or something like that. And no matter how you measure it, the stock was very, very overextended. And then it's a matter of how can you define what that turn looks like and what you look for in a turn and a change of trend or a break of trend, and then how do you play it? And so SMCI was something that went up, then it finally reached capitulatory exhaustion levels after what was otherwise a pretty orderly up move.
Right. So I think the thing that you just touched on is that this is a great story. Everybody will acknowledge this is a great story. Everybody's going to acknowledge that AI is going to be a huge deal and that this company is going to make a lot of money and everything's going to be great. But a situation like this never happens absent that type of catalyst. But what you also have is a situation where a stock just basically ran 700 straight points in a really short period of time that it's never done anything like before. And so a lot of that optimism is starting to get priced in. And if you have sort of a change in that trend, well, a lot of people could panic.
What's always so funny is there's always going to be a kernel of truth. Like, people will say, oh my God, but what if XYZ goes bankrupt? But oh my God, what if this really does grow by some rate? Of course, anything can happen, but it's that same euphoria where everyone takes it as assumed that creates the super euphoric up moves or the super capitulatory panics. And it's not about could it happen? It's, again, just simply what's the probability and what's the rate of change? Or is there an incremental buyer still willing to buy SMCI at 1,200 when the stock was at 800 a week ago? Or is there somebody willing to buy a stock at, or sell a stock at $4 when it was at $10 a couple days ago. And so that logic of, it's not just about the math, it's about the rate of change. And it's not necessarily logic, but it's a real market. There needs to be buyers and sellers. And if
This is something that I think you've really taken the next level in terms of identifying and taking advantage of, which is consolidation breakouts.
Yeah.
So we spoke a little bit about just like in general what consolidation is and what does it mean. And again, just the standard sort of disclaimer, which is that there's always going to be consolidation. If you type out any random chart, I guarantee you, if you type up Microsoft right now, unless something happens to be going on, there's probably going to be like a decent period of consolidation on that daily chart somewhere.
Yeah.
But if you're looking at a stock that's in play and you're finding a period of consolidation, you've been able to create a system where you're identifying breakouts or breakdowns in those charts. So a good example is URGN from 7/27/2023. This is just one I'm going to throw up there. Why don't you like maybe explain a little bit about the consolidation breakout concept and maybe a little bit about this, this chart in particular?
Yep, and I think the same way I talk about that bouncy ball concept, it's so important to find, and really all the trading is a mix of all these concepts, right? Because you need to find an in-play stock that's serving as the broken slot machine and doing something just idiosyncratic from the market. And so many people ask me, oh, do you care what the market does? And I say, no, I want to be trading stuff that's not moving with the market. The market generally is too noisy. I want to be doing stuff that, like this URGN, when that breaks, that doesn't give two craps what the S&P 500 is doing. That thing is going to go. And you want to find these tickers with fresh catalysts, like really big volume, big moves, big emotions, and you get that opening leg. It's a beautiful, I don't know, $3 move from where it opens and everything. We consolidate. The consolidation starts to get tighter and tighter. The volume, you generally want to see the volume start to die off midday. Then as we tighten up against those highs, the volume starts to come back in. We break those highs. And so now we've got a stock that's in play, a stock that's held up pretty well, at least in the upper half of its trading range, and then really, really tightened into that breakout. And then it breaks out on enormous volume. And so often when people backtest stuff, they're not really being nuanced about all those things. And actually, I did a recent rant that so much of the observations of retail traders, they're not following so much, is there breaking news on the stock or not? And those catalysts and these variables, like the volume, like the percentile of the consolidation, those are nuances that really stack your odds in your favor. And again, going back to that analogy, to succeed at this game, markets are so efficient. It's so difficult. You need so many variables all in your favor. If you're only looking at two variables and the other four are shouting no, that's not good enough. In this game, you need everything to align. Only when everything aligns can you finally get past the $0 expected value. And so you want setups like that offer very precise entries, very controlled risk, and just all the nuances saying this is a go.